Hello world, welcome back. This episode we're looking at a trade breakdown of a trade that I took on Thursday, the 22nd of May this year. This is a trade I took on the Nasdaq, which is an index. So this trade was executed on a sell stop. So I had my sell stop around 21,105.8, which was filled when price dropped down. So what I was looking for is a trendline liquidity to be swept. There had been an accumulation of trendline liquidity all through the session from London through Asia. I was looking for it to be swept, and I was looking for impulsive price action. That's why I had to use my stop orders, not a market execution, because I would have been affected by the spread. As you can see, the market dropped impulsively to the downside towards the drawn liquidity. Once the drawn liquidity was swept, I took my partials, dropped and dragged all my stops in profit at around 1 hour and held the position. I was still convinced that we're going to see a sell-off in this Nasdaq market, as there had been a long period of accumulation of orders. So there's a fair value gap there, which was in form of a CB, sell side imbalance, buy side inefficiency, which the market tapped, and it continued to deliver to the downside. So there's a bit of playing around in that fair value gap, which is in form of a CB. My stops were above the order block to make them a bit secure, and I was looking for price to go lower. Kindly note that at this point we've taken our partials, which are 3/4 of the position. This is after the liquidity was swept, so we've already bagged the trade, and we just want to see it run to a TP, which is not necessary because the trade has already been bagged. So in this case, the most important aspect for a trader is to understand liquidity and how it's accumulated. As you can see, that is my executions from the sell stop to the partials. I trailed even deeper because now price was nearing my exit point, so I'm trailing my stop a little bit more aggressive, making sure that I don't give back much if the position goes against me. So at this point, should have taken more orders out because price is a bit losing momentum at that point, as you can see, because I was expecting heavy price action to move to the downside, but instead I trailed even more aggressively on my stops, which was 2 orders in 0.5. There's 2 lots in 0.5, so I trailed more aggressively because now price was closer to my exit point, which in this case doesn't have to be swept because already the liquidity which was engineered throughout both sessions has been taken out. I see. So I'm sitting patiently. Now my objectives have been fulfilled. That stop sits around just above the liquidity that was swept. At this point, my expectation is it might go lower, but it reverses on me and takes me out. So it takes me out, and that was a trade. So it's important for you to use stop orders and limit orders instead of using market orders, because in that you're already picking a defense mechanism against the risk of the spreads once price begins to spool. So until we talk next time, be safe.